The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.
Show. Here we go.
Hey everyone, welcome back to another episode of In the Market Trenches. Before we get started, remember you can check us out on our blog at accretivewealthpartners.com. We're available anywhere podcasts are available. You could also check us out at inthemarkettrenches.podbean.com. You can check us out on snn.network, and you can check us out on the SNN YouTube channel. That's youtube.com/SNNwire. Welcome back. We're in person again.
In the flesh, baby.
In the flesh.
Thunderlips is here.
It's been a busy couple days.
Yeah. Crazy week. We're gonna take a slightly different approach to today, right?
Yeah, I think so.
Okay, cool. We've been having a lot of interesting conversations amongst ourselves and some of our friends and in various places, in various ways, shapes, and form. But it's sort of been an interesting sort of week or two. So we're going to sort of go in the trenches today, which has. I don't know if we set out to do this, but we felt like we had something to say and, conversation worth having. So.
I think a lot of people probably feel like they're in the trenches right now. So, maybe this will be timely for some people.
Especially the last couple of days, flashbangs going all around me, what have you. So one of the things that we've been talking about lately is the pricing mechanism in the market sort of starting to break down in certain respects. We've got the Robinhood crowd, we've got the FinTalk, the TikTok financial folks, we've got the Reddit threads and all of this sort of crazy stuff that's happening, and then high profile stock splits that for some reason are driving stock prices, and it's been quite an eventful kind of couple weeks.
And over top all of this, we're still in the middle of a pandemic. You still have a federal government trying to negotiate another stimulus package. And you have the Federal Reserve still committed to doing whatever it takes to get us through the other side of this.
Whatever it takes, for however long it takes, for it just all in. And so, one of the things that we noticed was a lot of managers have been complaining lately about some of the biggest stocks driving the market, and I think some of that is sort of a thinly veiled "dog ate my homework" excuse for how they're doing. But, one of the things that we've noticed was, some of the biggest companies out there, it sort of looks to us like the price discovery mechanism might be sort of breaking down, right?
Yeah. And so talk a little bit about this price discovery mechanism. I mean, what do you mean by that? How is price set? What is a company worth?
Well, that's really it. So you have all of these indexes out there, and indexing tends to work because people are out there. There's enough people out there that are working on price discovery, and they can essentially sort of be a free rider on the price discovery mechanism of all of the active managers that are out there. Right. And a common question is indexing getting too big? Is it getting too influential? And so I'm not a big believer in general that the indexing is a problem in and of itself in terms of the price discovery, generally speaking. But I do think it's reaching a size now where, because of some certain market structure issues, it is having an impact on how price is set in the market today. So they've gone from being a free ride for certain size companies. They've gone from being a free rider to being the price setter, right, in my view. And so. Just to talk about this, we're not going to talk about the companies themselves, but you have some of these biggest companies, and they're being, they're 7% of the index, and for the more pure indexes, they're over 10%, and so they're pretty darn big.
And so when you look at that and you compare it to who owns these companies, the shareholder lists. I mean, do people own these in proportionate size to the indices?
So that's the good question. Generally speaking, the answer is no. And so what growth manager has 10 or 12% of their portfolio in one holding? you have diversification rules that are for a lot of funds. You have position size limits and all sorts of things like that. And so, you have,
for your active managers, you also have the risk. You have the career risk on top of that.
right.
You have the risk of, would you get fired? So if you want to allocate 10% of your capital to one stock and that doesn't work out, well, you have career risk to that. It's a lot different than just taking a 0.5% or a 1% position in one of these companies. And so during this time, we have these large liquid companies taking up a disproportionate amount of the index, and the active managers aren't quite allocating in the same size that the indices are.
Well, and so money's coming out of all of these active managers, and let's say that these active managers, they're underweight relative to the market, these companies. So money's coming out of these managers and into these ETFs, into these index funds, which own it in more size. And so price in the market is set by the incremental buyer and seller. And so if you have, let's say, money's coming out of these people's hands and into the index provider, into the index funds, these index funds are actually a net buyer of these biggest companies.
Right.
And so they're no longer a free rider. They're instead driving the train.
Right.
That would be and so, it's something that is dramatically impacting the price discovery mechanism. It's only recent that this has become a real issue, because the concentration has gotten bigger in sort of some of these biggest companies.
And I really just want to crystallize this point, because it may not make sense at first. If I'm an investor in active manager fund A and they're allocated 5% to a position that really has a 10% weighting in an index, I redeem my funds from that fund, and then I purchase the index. Well, I'm going to be a seller over here. It's a 5% seller over here. But if I allocate to the index, I'm now going to be a net buyer of that stock in the index. And so you have a net capital going into this company that didn't otherwise have it before. And so that's what I think you're talking about with this incremental buyer or seller.
Yeah, so the flows into these index-related funds and products, I mean, they dwarf. It's just a wave of liquidity that's coming into them, and there's a big sucking sound coming out of the active folks.
Right. And
so, that dynamic has, up until this point, not really been an issue in price discovery, because the active folks, these position sizes weren't that much bigger than the typical what a typical active folk manager would have. But now they've gotten to a size where you've created sort of a market structure issue and a fund flow dynamic where, I don't know, I'm starting to wonder if prices, if these guys are for this subset of companies, which are the biggest ones, if they're no longer the free rider but the driver. And if that's true, what then should we do, right?
I mean, what would change that? What change? So let's operate under the assumption that thesis is correct. I mean, when does that actually stop?
I don't know, and that's part of the issue. So, and so normally you would have people come and try to bet against it, but like if you're standing in front of a freight train of money that's flowing into these products, like it seems like there's something is going on here that is not more technical and not fundamental. And so that to me, I sort of just think that it's going to keep going this way for some time. So I don't know how it ends, but
so you think this is different than a tech boom and bust? That was more fundamentally driven. That was companies that didn't really have real business models that ultimately failed.
Well, no, these are real companies that are really making money.
Tech boom.
Well, yeah. In the tech boom, there was some of this type of dynamic, because at the time, I don't think the indexes were float adjusting their weightings. So there was some of that dynamic that was part of the tech cycle too. But this is just an interesting new dynamic, and so like a lot of the folks that are, and I think net indexing has been a good thing for investors. Like it's saved them money. It's been more tax efficient. We do some combination of indexing and some other folks. So like it's something that we believe in, but it's the folks that are biggest proponents of this say, no, this can't possibly be distorting the pricing mechanism. I largely would agree with that, and I largely have agreed with that. But now that we have this dynamic is a whole new one that had not previously existed, because the concentration in these companies was not as big as it was.
Right.
And so at some point it was like they got to a size where a switch had been flipped, and now it's a different game. Like at this point in time, it strikes me that now it's a slightly different ballgame. And what's boggling my mind about this is I don't know how it stops, and because there's nothing structurally that's going to stand in the way of it. And then these are people that are voting with their dollars this way, right, in a rather systemic way.
Right.
And so I don't know. It sort of leaves me scratching my head. I don't know that I have any real good answers. It's just something that I'm watching. I'm staring. I'm kind of awestruck by it in a way, and I'm sort of just left scratching my head, saying, well, what do we do? And we've had a lot of interesting market activity, and it gaps up, gaps down, whatever, and it just strikes me that this market structure issue is still going to be there regardless of how the next whatever's going on today, however whatever's going on today shakes out, mm-hmm. Right? And so it just begs the question, what then do you do? And I don't, at this point I'm still sort of grasping for answers. I don't know. What do you think?
Yeah, I don't. So it's the question of what do you do, and also why does this impact certain companies different than it would others? There are some companies that I feel like this has been impacted to a greater extent than others, and I can't figure out why this market mechanism chose, this basket A versus basket B. I don't know.
Yeah, and it's more pronounced in certain companies than others, because certain companies have more of a retail holder base,
right,
versus an institutional one. But still, does it just mean that, so do these companies that are impacted this way, are their valuations just elevated on more of a permanent basis? If you asked me if I thought that the biggest companies in the world could be, you could have this dynamic impact what's going on with them this way, it's a new one on me. So I don't really know how to think about it.
And so how do you think index reconstitution plays a role in any of this? I mean, you just saw the Dow reconstitute the index. When's the S&P? When do they reevaluate?
They don't. Well, Russell reconstitutes their index every June. So every year they, market cap. They take all the companies and they rank them by market cap as of some rank date, and then they implement it at the end of June, which is a kind of, particularly for small companies, a fairly inefficient process, mm-hmm. for doing that. But the S&P, they're just, I'm pretty sure it's just a guy in a bow tie who leads a committee that decides. and so they say, there's some.
Why does it have to be a bow tie?
I think he wears a bow tie.
Okay.
I don't think it has to be a bow tie. I think it could be a traditional long tie. I mean, for all I care. But I think that the gentleman that chairs the committee, at least at one point, was a bow tie guy.
Yeah.
And I'm a fan of bow ties myself.
So if you can support a bow tie, more power to you.
I can actually tie my own bow tie.
Good for you.
And,
I can't do it.
I watched a British man on YouTube and I learned from him. And then I go do something debonair when I'm done. But there's some general rules for who can be in the S&P. But generally, I think it's four consecutive quarters of profitability, and then it's a certain size, and then they just decide. Yeah. And companies leave when there's M&A. Companies leave when they go bust, and there may be some other reasons I'm not thinking of. I guess if they're at 500 and they really want to include somebody, kick somebody out, it's probably the lowest ranking one there. Mm-hmm. But it's not really reconstituted. It's a market cap weighted index.
Right.
So the biggest companies have the most influence. I just didn't think that the biggest companies would get to be such a size, and the flow dynamic would be so strong into these index. And it's not just like pure blend like the S&P 500. You've got growth-oriented indices where money is flowing heavily into growth-oriented indices because growth has done well. It's done better than value. So, it's sort of this flow dynamic is having this impact because these companies are such a large percentage of not only the core blended benchmark, but the more specialty ones, like the NASDAQ or other the pure growth indexes. And so I don't know. I'm sort of just scratching my head wondering how it all shakes out, and I'm sort of grasping for answers. So you have this dynamic. And then you pile it on with some of these other things that are going on out there, like the whole Robinhood crowd. I've read some stuff about maybe some options, sort of driving some of this because the way the bookmakers there, mm-hmm. you've got relatively new unsophisticated people that are dabbling in options trading now, and so I'm told that option volume is more elevated than it normally is, and as this stuff's driving itself, the bookmakers there, they've got to. If they've written a call, they've got to go out and delta hedge it by buying the stock. So there's some dynamic there too. But I really think that this market structure issue is something that people should, one, take note of, and then two, care about. But I still don't know what you do about it. It's sort of like the antitrust issues that around some of these biggest technology companies. It's sort of like people are choosing to use these companies. It's not like Ma Bell when people hated AT&T because they were acted like a monopolist. It's a similar type of it's a similar type of problem, right? Because some of this tech stuff tends to be winner take all or winner take most, mm-hmm. and people are voting with their feet, and people are voting with their dollars, and so. But there's this. I never thought that I would have to worry about like index funds creating sort of a corner in some of the biggest companies in the world, but that's sort of what I think now is in the realm of possibility.
And so how do you know now if a company is overvalued?
So we're transitioning to a world, if this is the market structure, where fundamentals don't matter as much in terms of, and so do these biggest companies take on characteristics that are more like other things that don't like.
It seems like benchmarking or referencing historical multiples as a way to gauge a company's fundamental value today doesn't have as much weight in an investor's decision-making process, or maybe it shouldn't.
Well, it isn't. If that's the fund flow dynamic, right? If $4 for every you have all this money that's leaving people who are working on price discovery, and it's going into these vehicles where they don't care about price discovery. They're letting the market determine the price.
Right.
But if they are the market and they're setting the price,
right.
That's. I just don't know how to really think about that, and it's sort of breaking something in my brain because I like to believe as an investor that fundamentals matter. I'd like to believe that. I do believe that, but I'm looking at a situation here where there's this unique market structure issue, and normally what would happen is you might have like short sellers come in to try to balance out price discovery,
yep.
But I just don't know that there's enough money out there that's dedicated to that to even matter.
To short selling?
To balance out the price discovery. I don't because anybody who's doing short selling has had their face ripped off.
Right.
Just in general, there's a few really high-profile companies that people are very rabid about, and they've gotten their rear end handed to them, and so we at one point in time personally dabbled in doing a little bit of that stuff, but we sometime when did we give it up? Was it 2012, 2013? We decided that the skills that you learn from the skills that you develop doing work on the short side are very valuable, but they're more valuable on the long side to help you just avoid stinkers.
Yeah.
And
it just reminded me of another episode that we could do.
Oh, good. Good. There are one or two episodes where we could talk about what, on the dark side of things,
that's right.
Where we lost money, for sure. But there's not enough. I guess my point is there's not enough. there's something different about what's going on right now with these things, and I don't see what's going to change it.
Right.
And that's what's. If you don't think it's going to change, it also begs the question: well, what do you do about it? And so we don't have any good answers. We just have questions. One of the things may be that these index providers just have too much market power, and maybe somebody comes in and takes a look at the index providers, and
Well, I mean, so right now, and I'm probably getting a little long right now, so we can't go into this topic. But yeah, so they have too much power in terms of price discovery, but also, I mean, they now control a lot of the votes.
Governance.
Yeah. So they control a lot of the index providers are now going to control a lot of the corporate governance. And so that's a whole separate issue for another conversation, I think.
Yeah, I think that's actually a good topic, but it's sort of, if we could do hot topics in finance, governance is important for sure, but they would make the case that they have to own the stocks that are in the index, so they should care more about governance than anybody else because they're required to. I don't know. Not really sure about that.
Yeah, I don't.
This is one where we have more questions than answers, but it's something that we've been sort of discussing amongst ourselves sort of all over the last week or two, just trying to figure it out and trying to, think pretty deeply on the topic. We've heard some other folks that are, sort of talking about, the distortions that these things are creating out there. And that it's definitely, there's definitely some elements of it, but I've never wholly bought into it. I always thought that it was sort of just a version of sour grapes on the form of active managers that, that the indexing is getting too powerful and,
right.
and distorting prices. I always, I'm largely of that belief, but for this subset of companies that represent such a large part of these certain, it's people, whether you're indexing or you're not, you're still making decisions about what to do with your money and how to invest. So, you're just outsourcing the decision making to S&P or Russell or one of those, or MSCI. I think that encompasses almost everybody, anybody that is of any significance in the indexing game. But decisions still need to be made, and so, but it's just happening in a different way, and it's sort of this unusual thing that I don't really know, as I think deeply about everything that we've got going on, how to really think about that more.
Right.
And there's one thought where you would just avoid it. There's another thought where if this is what's going on, just accept it and join. And then there's, but it's one of those things where there are no easy answers, only difficult questions.
Right.
I think that's a good place to leave it.
Yeah, I think we'll wrap it up there. I mean, that was, we wish we had answers. We don't. We have a lot of questions. If we have any epiphanies, we'll certainly share them with you.
If any of you have answers and you want to reach out to us and help enlighten us, that would be just awesome, because, this is one of those things where we're thinking about more, we're talking about more. We have to recognize it as part of our process in terms of what's going on out there. Quite frankly, the market doesn't care what we think. As much as we may sit here and pontificate, the market doesn't care what we think, nor is it going to listen to us. So,
and for all investors, it's you want to accept that early.
Yeah,
the market doesn't care what you think.
Market does not care what I think. And, that's a lesson I learned over the years. But anyway,
so yeah, feel free to reach out to us. You can find our contact information on our website, www.accretowealthpartners.com. You can check out our blog there. Remember, this podcast is available anywhere podcasts are available. You can check us out at inthemarkettrenches.podbean.com. Check us out on snn.network or the SNN YouTube channel. It's youtube.com/SNNwire. What am I leaving out?
Rate and review us. It helps a lot. And if you want to be a guest on our show, we're looking for guests. We'd love to have you on.
All right. Thank you, everyone. Look forward to talking to you next time. Take care.
The information in this podcast is educational in general nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.